Hello, good afternoon. Today is my second video in Nether Talks Accounting, and as I said in my prior video, or the first video, that we're going to be talking mainly about accounting, and we're going to start from the beginning. And the first few videos, I'm going to try to keep them short, like maybe 5 to 10 minutes. This way we can get the feelings of how to really start talking about accounting in general. Okay. Accounting, if we're going to talk about accounting, we need to talk about what is accounting. Accounting is the process of getting the information, the financial and accounting information, and then recording it. And then at the end of the period, or end of year, or every now and then, this information is used to do measurement, to kind of know where the company is standing, what the company is doing. So this information can be used internally or externally. Internally could be the management, department management, executives, also owners. Externally can be, we can say auditors, we can say investors, banks, whoever wants to get the information and to know about the company. Like if somebody wants to buy shares or to buy or to invest somehow, or like a loan officer that's giving a loan to the company, whatever is going on, the accounting information is always important to understand how the company is doing. And we're going to talk more about the financial statements, but the first financial statement that talk about or show you the accounting in a period of time is the income statement, or profit and loss. Some people call it profit and loss, and the short will be P&L or balance sheet, or the income statement. So the income statement is taken, it's like a video recording that's showing a period of time. So it's like, let's say the income statement for 2018, so it's going to show you all the revenues and all the expenses that occurred in 2018. On the other hand, there is the balance sheet statement. Balance sheet shows you, it's like a photo shot. So it's a picture, so it's almost like the difference can be like whatever, it could be MRI versus X-ray. The balance sheet is the X-ray because it shows now. This is just focus on now, what is the status of the company, what assets the company has, and what liabilities the company has. So this is in a quick way to show what the income statement is used for and what the balance sheet is used for. The main thing that we're going to start talking about first, before we get to the statements, is we said, what is accounting? So accounting is entering the information. That's accounting. So it could be entered by a payable clerk or a payable accountant, and then on the other side you got the receivable, you got the people that enter sales. So some companies, they have, like if it's a retail company, normally they have somebody who enter the sales, or it could be like the stores, actually. When you go to a store and you buy something, this information is part of the accounting, because it's going to go in and it's going to be taken in the system of the accounting system and create the revenues. And then every time they purchase something, that's going to go to the expenses or assets. So this is the accounting. Everything you enter or record, it's part of the accounting. Anything that has to do with, again, revenues or expenses, or whether you're buying assets, you're buying supplies, you're investing in something, you have CDs in the bank, you have, let's say, saving account, whatever you have in the bank, or you're investing in other companies. Let's say you have a profit, you have stocks and in other companies. That's going to be recorded in the accounting. But then before all of this, we need to talk about the debit and credit. As I said in the first video, we were going to have to emphasize on the importance of understanding the debit and credit. Every time you create a transaction, you are making a debit and credit. So again, whether a lot of people think that, let's say you're using QuickBooks because you're entering information on a check in QuickBooks, and you enter the vendor in the payee, you put the vendor name and the amount, and then you select the expense. This is it. Well, yes, it is. But in the background of the system, if you looked at the reports, General Ledger report or anything, it's going to show you as a debit and credit. So it could be, if you are making a check to, let's say you pay in utilities and you're recording the check to the utility company, so it's going to debit utility and credit the cash. So it's going to debit the expense and credit cash. Let's say you are entering money that came in, and because you sold something and it was recorded in a receivable, so you record something. So the money that come in, when you record it, whether you're creating a cash receipt, whatever system you have, every system has certain ways of recording money coming in, when could call it undeposited funds or whatever the names. You're going to debit cash and credit receivable, account receivable, AR. So what are the difference between the two transactions? The difference between the two transactions, and again we're going to talk about it more later, is that first we're going to talk about the common thing between the two. And from there we're going to see the difference, because there is a theory behind it. The common thing is cash. But one, we spend money. We cut a check to the utility company and we're paying the light bill, so we're paying utilities. So, in this case, the utility expense went up. Cash is going to go down. Then here, we're going to debit, but here, we got money. Money came in, and the transaction was recorded in receivable. We sold something, and it was recorded in receivable. So, this here, money is going up. The cash is going up. The cash is increasing. So, in this case, we're going to debit cash and credit AR. But are we going to just memorize that? No. There is a theory behind it. And the theory is, if you see here cash, cash is a current asset. It's an asset. The assets, any asset, will go up by debiting. So every time you acquire an asset, you debit the cash, debit the asset. And if you spend money or asset would go down, current asset, like here for example, AR is asset. Because you received the money, so the account receivable will be lower, because the more money you get that was sitting in the account receivable will go down. So account receivable went down by the credit. So assets and expenses, debit. If they go up, so we're going to say here, so the debit and the credit. So we got the assets and expenses. Credits, revenues, and liabilities. So that's what increased, and that's so we're talking about the increasing, going up. So the best way to can remember, and that will make sense, assets and expenses always debiting when they're going up. And of course, if they're going down, you're going to credit. Revenues and liabilities always credited when they go up. And of course, if they're going down, you're going to debit. So that's what makes the two sides of the equation always or balancing in the end. Because at the end of the transactions, they have to balance. So when you look at trial balance or list of the balance, the credits, total credits always have to equal total debits. Otherwise, there's something wrong. And of course, if you're using an accounting system, most of the time, this is the only good thing about accounting system that will help you. It would tell you that it doesn't balance. Let's say if you're trying to enter a journal entry, and like you put here $100, but here you put 105. It's not gonna let you enter it. It's gonna flag it and it's gonna tell you the journal entry or the check or whatever doesn't balance. So at the end of this is how the transactions will look like in the accounting in general. So to wrap it up, assets and expenses always debited when they're increasing. Revenues and liabilities always crediting when they're increasing. And it's always going to be the opposite when you are decreasing. And again, this is the end of my second video. And please subscribe and like and put a comment, and I'm going to start checking on the comments and the question that any one of my viewers have, or if you need more information, or if you need me to go back. And this is just an introduction to the beginning of what is debit and what is credit, and we will talk more and be more in depth of assets, expenses, and all these things in the following videos. And so I'll let you like watch this, and hopefully please let me know if you have any question, and again, subscribe, like, and leave a comment, and I'll be back with another video. Thank you. Bye.